lot of glare. I apologize for that. How long should you hold on to an asset? Well, it depends. What is an asset? Let's define it first. An asset can meet two definitions. Number one, an asset is a thing, an investment that appreciates in value over time. And that appreciation is at a rate that is faster than inflation. Now, inflation typically somewhere around 2.5% to 3%. If you look back over the years, 2.5% to 3% annually is what inflation is running at. So if you can get an asset that appreciates, or an investment rather, that appreciates at a rate greater than that, then you have an asset, because it is growing in terms of the value. It's becoming more valuable. Now, there's another definition of asset that incorporates that, a thing, an investment that appreciates in value over time at a rate greater than inflation and provides income. That's also an asset. Let me give you some examples. Rental property. Rental property is provided that the rent the tenant is paying is satisfying the mortgage on the property and all of the expenses, and after that, some profit is generated, plus the underlying value of the property itself is appreciating, again, at a rate faster than inflation. That's an asset. Now, of course, I am a financial professional. I'm not your financial professional. You've got to do your due diligence. But a lot of times, properties, real property, real estate, will appreciate in value. Now, depending on where it is, will determine whether or not it appreciates in value at a rate greater than inflation. So in that scenario, you've got an underlying asset, the real estate, and the rents being paid, the income, provided it is providing income. In those scenarios, you have an asset. If that is the case, you have an asset. How long should you hold on to it? Well, that's a long-term investment. If it's providing good income, maybe that's something you could actually incorporate in your will and trust and pass on as generational wealth to your heirs. Now let's look at real estate from a different perspective. Let's talk about real estate that you want to get into and you want to improve it in order to sell it rather quickly. You don't want to put a tenant in it. You just want to improve the property. So you go in, you rehab that property. You've purchased it at one price, you rehabbed it, and now you're going to sell it for a price higher than it cost you to purchase the property and to rehab the property, okay? If you can get away with that and make a sale that is higher now that you have put some quality improvements into the product and made it more valuable, you've brought it up to the standards of the comparable properties in the neighborhood, you just sold an asset. And that would be an asset that you would hold on to in a temporary fashion, because you're trying to get in, get out, improve, and put that bad boy on the market so that you can get some money out of it, some profit out of it. So those are examples of the nuances, the differences in terms of how you should view how long you should hold on to an asset. You've also got the example of when you're dealing with a stock, for example. Now, stocks, some of those, again, based on your due diligence and your strategy, your investment strategy, some of those are worth holding on to long term. Now, I am an investor. I'm not a trader. Traders get in, they look for little price increases, and then they get out with a profit on that. That's something that works for some people. Doesn't work for me. I don't have time with all of the other things that we do. I don't have time to sit in front of a computer and watch these minute fluctuations all day, but there are some people who do. So that would be an example of, okay, the trader is going in and he is making trades, boom, 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 all day long, or he'll hold on to something for a week or two. He's not holding on to that asset long. Hopefully it will be an asset for her, because their hope is that they will buy it at one price and then be able to sell it at a higher price, in which case they realized some appreciation. Hopefully that appreciation was higher than that inflation rate we talked about earlier, thereby turning that into an asset. Now, a lot of people are investors, long-term investors. They buy a stock and they hold that stock. They hold it, and it may be a stock that's a growth stock that doesn't have any income attached to it, or it may be one of these older blue chip stocks that appreciates in value while kicking off a quarterly dividend income. Okay, so that dividend is basically, you can think of it as you're being paid to own the stock. Okay, the company is giving you income to own that stock. So you're realizing that income, and if that stock is appreciating, hopefully it is, because then that makes it an asset, then you're in good stead. Okay. So those are examples. You can look at any asset in that way. Even a business. Let's say you go out and you want to purchase a business. Well, you've got to look at the numbers on that business to see if it has been growing, and at what rate has it been growing. Also, what income has it been providing? Those are factors you need to look into. You need to examine that business's balance sheet. You need to examine the business's profit and loss sheet, and to help you determine those factors. If you can't do those things, if that's part of your due diligence, if you can't do that, then you have no idea really what you're investing in, and you have no idea whether or not it's a good investment, or how long you should hold on to it, or what have you. There are people. Reginald Lewis was a guy from Baltimore, and he was one of these venture capitalist guys that would go in and he would purchase a business, he would make some improvements to it, and then he would sell that business. Kind of like what we talked about earlier with rehabbing property. A business is property, and Reginald Lewis would look for different ways to improve the businesses that he invested in, and then turn around, make those improvements, shore up the balance sheet, cut costs wherever he could, and then sell it. Now it's more valuable. He would sell it. So you can do that evaluation with any asset class. Is it going to provide you with a return that's greater than the rate of inflation? And is it going to kick off some income? And if it does, then that's one point in a multifaceted set of due diligences that you should use to evaluate an asset. All right, talk to you soon.